Hello, and welcome to the Virtual Investor Conference's March 14th OTCQX Banking event. My name is Bob Power, and on behalf of OTC Markets, as well as our co-host, Better Investing, we're very pleased you've joined us for our next live presentation. Before I introduce the presentation, just a few quick points. Please submit your questions in the questions box below the slides. Once the Q&A session has ended, don't log out. You will automatically be transferred into the First Resource virtual trade booth where you can continue to ask questions via chat and access a library of shareholder materials as well as links to the company's website and other key information. Lastly, all presentations are recorded and are available for 24/7 replay at your convenience. At this point, I'm very pleased to welcome Glenn Marshall, President and Chief Executive Officer of First Resource Bank, which trades on our OTCQX Best Market under the symbol FRSB. Welcome back, Glenn.
Thank you, Bob. Welcome to First Resource Bank's Virtual Investor Conference, March 14, 2019. Let's start off with a quick look at the forward-looking statement. Thank you. For those of you that are returning to our call, I'm going to take a couple minutes and give our new listeners a little background on First Resource Bank. We're a community bank. We're based in Chester County. We have two high-profile branches, one in Exton and one in Westchester. We think branches need to be billboards. When you look at the picture that's the insert up in the right, that's our Exton location at night. One of them on major thoroughfares. In addition to being retail locations, they're advertising for the bank. Working on a third location in Wayne, same thing. It's going to be on Route 30, major thoroughfare. We established the bank in 2005, and the executive management team was the people that established the bank. Lauren Rinaldi is working behind the scenes here as the producer of this broadcast. So we started the bank from scratch. Let's go on and look at the market. We primarily started the bank 15 years ago in Chester County. We've expanded our footprint for both lending and deposits into Chester, Delaware, and Montgomery County. What a great market. There was just a report this week through the Brookings Institute Prosperity Index, which looked at a whole lot of different factors, but Chester County and Montgomery County were 1 and 2 in Pennsylvania. Delaware County came in 7th. So great market. When you look at this, the numbers are off to the side here. Chester County has the highest median income in Pennsylvania. Montgomery's number 2, and they're 1 and 2 in pretty much all the categories that you look at for good economic situations and growth. And Delaware County was 4th in median income. So we couldn't be in a better location in Pennsylvania. We think it rivals some of the best places in the country. And when you look at the evolution of community banking, the days of being a $500 million bank with 8 branches, we think we're just evolving away from that. We like to refer to ourselves as a hybrid community bank. We're going to have a limited number of high-touch branches. People want to deal with the banker. They want to be able to come in and talk to somebody. But we're going to complement that with as much technology as we can get, be on a par with national players. We have a core processor that helps us do that. So that high-touch, high-tech is really the hallmark of First Resource Bank. We refer internally, say we don't need to be on every street corner, but we do need to be available 24/7. Your cell phone is your branch. It's in your hand. You can get to the bank and get to your information 24 hours a day. The little insert in the left is our Westchester location. You can see the branding on both locations is the same. Let's go look at technology. We get 58% of our daily items deposited through our remote deposit or our mobile banking electronically. We're right there where we should be with the evolution of community banking. I talked to a reporter earlier this week, and he said it's been 15 years. Are you where you thought you would be? And they said to me, 3 years in, there was this technology boom that occurred in community banking, and we grabbed onto that. So if you ask me that in the last 12 years, we're exactly where we thought we would be. We saw this trend in the sticks and bricks and the branch side, and we really grabbed onto the technology. And this hybrid community model, we think, is the future of community banking. And down below, you can see this is our FRED machine, remote deposit capture machine. What we do in that area is that's a free service. We think that the free offsets the cost of a branch. We'll talk about that a little bit down the road, but we're getting into those customers because we're providing that service electronically and free. Let's look at the highlights of 2018. We have slides to back all these bullet points up, but the press release is on our website, dated January 30th, 2019. We'll have a lot more detail if you want to go back and look at that after the broadcast. Record profits, we grew 28%. We finished with footings on the bank of over $300 million. Strong checking growth, non-interest bearing was up 27%. We talked earlier, we acquired the Wayne location. We're actually putting curbs in, I think, today, so we're chugging along with that. And loan growth of 13%. It's the 5th consecutive year of double-digit loan growth. We set the presentation up to start on the income statement at the top line and work our way down. So there's 3 or 4 slides here. We're going to work our way down to net income. So year over year, we had 17% growth in the top line from 17 to 18. That was on top of 15% growth from 16 to 17. So we love our growth. We love the expansion of our income. And obviously the key is how much of that can you preserve. So when you look at the net interest margin, our net interest margin for 2018 was 3.89, up 3 basis points from 17, which is 386. Now, if you're in community banking, you'll know that in the course of 2018, it was a crazy retail deposit market. We got through the first quarter pretty stably, and the last 9 months of the year were just crazy. It was almost like a rubber band snapped, and all that kinetic energy on the retail deposit side just translated into rates just kind of going crazy. We're really happy that we preserved our margin. In the fourth quarter, we were 385. So we were really happy with how the margin held up over the course of the year. We have a peer group in here, which is $100 to $300 million banks in Pennsylvania. We've always had a positive variance to those banks. At the end of the year, in the fourth quarter, it was 25 basis points, and it's generally been 25, 40 basis points, depending on what's going on during the course of the years. And you can go back in that chart and see that the variance has pretty much been there over the years. So the next step, let's walk back down and look at overhead. We're always going to do smart growth. We're going to add lenders, deposit gatherers, technology. Firewalls aren't free. We need to protect the bank. Obviously, we're going to be adding another branch. So we're always going to try to absorb this overhead in a smart way as we grow. And we think we've done that. If you look at the blue line here, we've had some oscillations there, but generally we've been pretty consistent. At the end of the year, we were 2.67% of average assets. I can't really tell you what's going on with the peer, the red line. They were 367. That's a 100 basis point gap. That just seems a little bit more than what we've had in the past when you go back and look at that chart. But we've always had a positive variance, always had really good overhead control, and added it in a smart way so we knew we could absorb it with our future growth. So all that's going to translate to the net income growth. Net income grew 28%, 17 over 18. 16 to 17 was 32%. So if you look at that 2-year period, we went from making just under $1.3 million to making just under 2.2. Yeah, there was a tax rate improvement in there, but that's not all the tax rate. I mean, we're doing the right thing. We're really working hard to improve the top line and push it on down to the shareholders in the way of return on equity and return on assets to the bottom line. So when we look at the balance sheet, we're always going to be a growth story. We're always trying to fund the model of the bank on an organic basis. We want to grow loans, try to stay within an hour of our Exton location. We want to gather deposits in a similar fashion. Obviously our primary deposit gathering locations are Exton, Chester County, Delaware County, Montgomery County. But we're looking to do that hour from Exton. We think that as we grow, and when you look at this chart, we continue to try to stay in balance on loans and deposits. I kind of laugh. I look at 13, and it's almost like it was a mistake because it was perfectly in balance. It's never perfectly in balance. So When we have a loan spurt, we're looking for deposits. When we have a deposit spurt, we're looking to deploy it. So, but we love where we are with our growth, and we think this chart shows our continued growth over an extended period of time. So let's look at deposit growth. So deposit growth is really people, process, technology, and locations. When you look at this chart, and there is a lot going on, but let's focus on the yellow line. At the end of the year, we had 18% checking of overall deposits. We kept this information as long as we did because in 2021 we were under 7. There was an occasion, and Lauren, I can't remember specifically when it was, but I think it was in 13, where we looked at each other and said, we've got like 5 people calling for loans and 1 person calling for deposits. We need to do a better job of this. So we really looked at the people, we looked at the process, we really changed what we were doing all around. We added some really talented people on the deposit side to really get this percentage up, and those folks in the team, they know checking, and that's what they hear all the time from us, and they hear from everybody in the branch system. So, when you combine those people, the process, the technology, we think that we figured it out. And the other thing is, in that checking it's not a game. I mean, it's non-interest-bearing checking. Non-interest-bearing checking was up 27% in 18 and 33% in 17. So it's really just basically business checking. Our consumer side, I think our business accounts are 84% of our overall checking. So we think we've got it going on the deposit side, and we just need to keep going. So the last piece of that people, process, locations, and technology is obviously the locations. So we were in Exton for 10 years. We actually moved that branch from its original location so we could brand it. That location has $154 million. It's in the top 20 branches of 180 plus branches in Chester County. Our second location, also in Chester County, is in Westchester. It's got $75 million at the end of the year. It's on a corner that has $400 million. So we don't put a location anywhere that we don't think it can get to $100 million in 5 years. We think that's one of the basic premises of everything we're doing. We're not going to put a branch in a location that's going to, be the weak sister. We need to perform. So we look at Wayne, same thing. We think that's a great location for us. Major highway, Route 30. It's across the street from a popular diner that's open 24 hours a day. That billboard will just be screaming at everybody that goes in and out of there. The interesting thing about this location is it's a lot smaller. It actually fits on the footprint of what was a house that was there before. We love this design. We think this is the future, the branches in the future for us. It gives us a lot more flexibility with locations because it fits on a much smaller footprint. The first floor is 1,100 square feet, and the second floor with the tower out of it's probably only about 800 square feet. So love this look, and as it says here, we hope to have that open in September. So the key to Wayne is that it gives us a triangle. I drew mine on my slide, so feel free to draw it with your finger. Exton's a $2.4 billion market. There's competition. You can see the number of branches in that market. Westchester's a $3.1 billion market, and then Wayne adds another $3.7 billion. But the beauty of those points in the triangle is we capture the submarkets in between. That gives us $12.5 billion. That's a lot of deposits to go mine, a lot of checking, a lot of small businesses. We love the footprint that covers for us and what we can do to take advantage of that in the near future. So let's look at the loan growth and a couple things. Geographically, I said that we tend to stay within an hour of the Exton location. Principally we're in Chester County, Montgomery County, Delaware County, but if we can get in the car and get there in an hour, that's generally where we're going to be. I mean, that growth over the last 2 years, we were 13% last year, 10 the prior year, and then 12 each of the 3 years before that. So pretty consistent, pretty solid loan growth. We'll look in a little bit at the configuration of that, but we're sticking close to home. We want to be able to service those customers, and we want to be able to hop in the car and get there. We've done that with really picking up some talent. We've picked up some talent as a result of some mergers. We've added we've added 2 or 3 really good people over that time frame to really enhance our lending pool, which obviously adds to our growth. So we look at the mix in the portfolio, and it's about growth versus risk. We think we have the right mix there. We've had good growth, but we don't think we've had wild growth. We don't think that we've taken an excessive amount of risk with underwriting or geography or buying things on rates, or more importantly, buying things on terms. So the configuration of the portfolio as it stands at the end of the year, we're going to go counterclockwise here. So if we started at consumer other, that's second lien loans. The one lesson that we learned out of the Great Recession was, being second on a house that has a valuation decline is not a great place to be. A lot of our prior losses in that period were a result of that part of the portfolio. So we've continued to de-emphasize it. It's down to 2%. We're not principally a large consumer lender. You can see the combination of consumer other and consumer first is only 9%. Our core competencies in a couple areas, one of which is 1 to 4 residential loans. These are investors that are buying houses. They might be finished and they're just putting them in their rental portfolio. They might be doing a significant rehab to them, or they just literally might be doing the kitchen and the bathroom. Whatever you're doing, we have folks that understand it, and we have a good competency to help you do that. And you can see that's 19% of the portfolio. As we go around clockwise, you can see commercial construction. And that's small business lenders. By and large, it's residential, folks that are building 1 to 5 houses a year, spot lot builders. That's their business. They're not doing tracks. We're not big enough to do a lot of big track stuff, but they'll do some subdivisions, 2 or 3 lots, and that portfolio has generally been about 100% of capital and 10% of the portfolio over the years. When you combine C&I and CRE owner-occupied, you get 37%. That's the business owners, lines of credit, term loans, going to buy my location that I'm in. Good for checking because we have the operating business, we have the operating accounts for that business. Always going to be a core competence of the bank. Commercial other is multifamily. We have not built the expansion of the portfolio on multifamily. I think we have 1 loan that's a multifamily that's more than 100 units. That's just not what we've been doing. And all of those properties are in Pennsylvania, so we haven't stretched geographically and done a lot of multifamily to make a big growth in the loan portfolio. CRE non-owner occupied. I'm buying a industrial property and I'm renting it. It's just what their business is. We have a lot of people that their business is real estate. They're just entrepreneurs in real estate. So I'm going to look at asset quality. I think this slide sort of divides into 2 pieces: the Great Recession piece, that's 12, 13, 14, and then the recovery, 15, 16, 17, 18. When you look at our charge-off rate in the Great Recession period, and it was 44 basis points. So clearly there were things that happened in the economy that weren't solved overnight. People had to work through situations. We worked through situations with them. And you look at the cleanup period, the post period, we're back down to 9 basis points. A thing happened this week that I think is noteworthy. We work with borrowers to help them get to a better situation over the course of the Great Recession. We had an entrepreneur operating his business, bought the building in 2009. Unfortunately, had a lot of problems and went on non-accrual in 2013. And we work with them. He paid what he could pay. He eventually got to paying a full payment. He sold that building late last week and had the good fortune to be able to put a couple $100,000 in his pocket after he, satisfied all his obligations. It was just a good feel-good story from a community banking standpoint, and that's reflected in these numbers. We have tended to just not pull the trigger on people. We want to work with them. When they need money in the future, they're still going to be able to be a customer for us. So best bank in Chester County 2 years in a row. We love the first one. This is a voter. The readers of the Daily Local voted for this, so they voted for us back to back. This is really a reflection of our customer contact people, the team that's out there. A lot of it's on the retail side. Those folks have a lot of contact with the customers that are coming in, that are doing the voting here. Couldn't be prouder of them and couldn't be prouder of that accolade. When you look at the next slide, you know, things that we've achieved in the last few years: best bank for 3 of 5 years, Lauren Rinaldi, CFO of the year for the Philadelphia Business Journal, Bauer 5 stars. The most recent one is the school district that's in Westchester, where they're community partner. We do a lot of things in the community. We're very proud of that. We think that is the right thing to do. It also is now getting a lot of traction with people that are coming to the bank, both recruiting employees and actually recruiting customers. We're looked at very nicely in the community, and it's been a big benefit as we've grown the bank. So let's look at 2 more charts. The first one is the stock performance. So we picked 5 years. It's a long time, but when you look at it, I'm just going to flip down to the bottom real quick before I talk about the December dip. Over those 5 years, we were 77% growth. S&P was 50% growth, and the KBW index was 45%. So good growth over a long time. We think we're a long-term play. When you look at the December dip that we all had, we had a separation between ourselves and a lot of these indexes before the dip. We suffered in the dip. And then we bounced back, and we continue to bounce back. And I love this chart, both over the long term, but also, you know, when you look at January, February, because we really did bounce off of that sort of, you know, getting grouped with the herd, and that separation is back for us. So we look at book value to market value. Clearly, we continue to add to book value every year. That's the blue line in the background there. The yellow one that jumps out at you is price to book. You know, obviously we have less control over the market, the December dip. I mean, we clearly have control over what we do with book value and how we grow it. In February, our price to book value was back up to 113. We absolutely think there's room there. You know, I've said over the years when we've done this that we're an undervalued proposition, and I continue to think so. I think there's upside here in the stock, and you know, at the end of this thing, I'm supposed to ask for the business. I'd love for you to add First Resource Bank to your portfolio, because I think you'll benefit from it, you know, in the future. And take a minute here. This is the last slide. This is Lauren's and my contact. Feel free to email us, call us. We're happy to talk to you at any point. Little housekeeping. There's going to be some questions after I take a drink, and then we're going to go over to the First Resource trade booth, and you'll go over there automatically. So hang on 1 second. Okay, we're back. So the question is, what are the drivers behind your growth in assets? So I think there's 2 pieces. Obviously, really good people. You know, on the lending side, it's always a battle. Every deal is a battle to get it done. On the deposit side, I think we've configured things so that we are the most attractive proposition, and we combine that with really good people. We do a lot of things for free. Remote deposit capture doesn't cost you anything, because the offset to charging for that is we might have to have more locations. So when you go to our website, you click on the free schedule, you'll see there's a lot of things we do for free. That's part of our marketing. That's part of our attractiveness. That's how we get non-interest-bearing checking growth that we've gotten in the last couple of years. So Steve Fisher asked, like the style of your branch, any plans for future branch expansion? Steve, yes, we will, but we got to get 3 up and running. I'm right now, I got curbs, and I don't even have a building. But we continue to look for those geographic areas that we're in now, but in a casual way, that could support $100 million. You know, if I have a new branch in Wayne, I got Westchester that's still growing, and I've got Exton, I have capacity to get deposits without adding the overhead. Remember, a branch costs you let's say $45,000 a month in overhead. The remote deposit capture is a fraction of that. I mean, $1,000 a month. So we probably want to take advantage of the 3 locations that we'll have at the end of the year, and just keep our eye on where the next one is, but not pull that trigger too fast from an overhead standpoint. John asks, what dynamics do you see in your local market that First Resource Bank's well positioned for? Well, you know, from the day we opened the doors, we've had disruption with long-time players in the market, other institutions. You know, we've continued to take advantage of that, both from a standpoint of acquiring talent, but also the disruption. I mean, you know, I think fundamentally people want to deal with the community bank. You know, one of my examples here is I work for an institution that was Elverson National Bank, that then became National Penn, that became BB&T, and now is going to be part of the 6th largest bank in the country. There are customers there that we need to touch that clearly are community bank customers. They want to deal with the community bank. You know, we continue to see that disruption. You know, why are we going to Wayne? I mean, there was a very good community bank down there, Penn Liberty, that isn't there now. We think there's a void in community banking in that market that we can take advantage of. We continue to see it, and we continue. The call for us is that we need to be able to take advantage of that disruption in the market and continue to grow. Mark's question, you mentioned your core processor helps you achieve the business plan. Can you disclose the core processor? Sure, it's Jack Henry. Jack helps a lot of community banks, and what Jack does a decent job of, and I think I'm going to say a good job of, they'll reverse engineer a product from a technology standpoint so that we have it to roll out. Obviously, they're charging us for it, so we got to add our overhead in a smart way. But it's nice because, you know, they have it already on the shelf that we can kind of pick and choose which technology we need to add. I got a Mark question. Do you see pressure on credit spreads, and where do you see the margin in going in 2019? You know, Mark, if you asked me that question in June, I would have thought that our margin over the course of 2018 would have had more constriction to it. The lending staff did a great job. The deposit side juggled like you can't believe. You know, fight the fights that we needed to fight to have the cash to fund the loans, but not do anything. You know, like we always refer to it as not making the big stupid mistake. There's always pressure on that. There's pressure when rates are down, but hopefully if the Fed does half of what it says it's going to do, which is nothing, you know, there's some talk about later in the year there might be 25 basis point decline, maybe there's 25 increase. I don't know the answer to that, but I do know there's not going to be 4, and that's a help for us because people tend to look at this stuff less when rates are stable and they don't hear it in the news every second. What's your level What's your level at all if you utilize brokered deposits? So brokered deposits are 2.52% of our total deposits. It was higher 5 years ago. We have spent a lot of time getting more organic. You know, with the change in our process on the deposit side, we've absolutely positively shed broker deposits, and we think that's a healthy thing for the bank. So I'm getting the cutoff on the time. I appreciate you listening in. Obviously, this will be recorded, and will be on our website if you need to go back and listen to something else. And I appreciate you joining us. Thank you.